Nasdaq is down almost 7% from its all-time highs. While I try to keep my portfolio balanced, it is tilted towards growth. If you have something similar, you are feeling the pain. As always, media loves to throw fancy terms and make it sound catastrophic. Let's simplify this a bit, and if the sell-off continues, talk about why this could be the long-awaited buying opportunity. Hey guys, welcome to Think Finance. My name is Raj, and on this channel, I talk about personal finance, investment ideas, and everything money. In January, I did a video discussing my portfolio and investment strategy for 2021. Since October last year, I have paused my monthly contribution. Simple reason, my portfolio was up big, and at some point, I was expecting some sort of a dip. And if we saw one, I wanted to have some cash available to buy the dip. Last week gave us some early signs of a dip, mostly in tech and growth space. In this video, I want to share my opinion on why this sell-off. I believe media and analysts have overblown this to some extent. If the sell-off continues, this could be the buying opportunity that some of us were waiting for. Stick around till the end to learn about how I'm managing this dip. By now, most of us understand the so-called rising bond yields is a reason for the sell-off. You cannot miss it, it's all over the news. But what does this mean, and is it really a reason to sell? Now, this can get really complicated, so I'm going to try and keep it simple. It is important to understand just a bit about bonds and yields. The government issues short and long-term bonds for investors. Bonds are an investment tool that allow investors to lend money to the government for a certain period of time. In return, the government promises to pay interest regularly, and when the bond agreement ends or matures, investors get their money back. Just like stocks, bonds have a face value and a yield or interest associated to it. Short-term bonds offer less yield compared to long-term bonds. Long-term bonds come with risks and uncertainties for which investors expect a premium, and that is reflected in a higher yield. Just like stocks, demand drives the value of bonds. Higher demand will drive the value of bond up, thereby reducing the yield, and lower demand reduces the value of the bond but drives the yield up. Now let's introduce the yield curve. A yield curve is just a curved line that plots yield or interest rates for the bonds across different maturity dates. In this chart, 1-year short-term bond has a yield of 0.5%, and a 10-year long-term bond has a yield of 2.1%. Now, this is not a yield curve 101, but rising yield curve is considered normal and is a feature of a normal yield curve. What does that mean? See, US Treasury bonds are considered safe. When the price of long-term bonds, let's say 10-year bond, goes up, yields drop. This means investors want to park their money in safe US long-term bonds as opposed to investing in other forms of assets. This is a signal that investors are expecting economic downturn in the short term. This is not the case right now. Demand for long-term bond is down, which is the reason yields are up. A normal upward sloping yield curve means investor confidence or sentiment is high. Investors are convinced that economic growth will be strong. But this also means that they expect inflation, which means there is a possibility that central bank will implement tighter monetary policy by rising interest rates in the future to slow down growth and put a check on inflation. Here is why I think you should treat all this noise as a buying opportunity. Number one, yield on long-term bonds are rising on the anticipation of inflation and lower demand. Anticipation as opposed to actual inflation. Number 2, rising yield also means economic recovery and investor confidence. Investors believe we are on track for an economic recovery. Number 3, investors are worrying Fed will raise short-term interest rates, which is usually bad for stocks. But Powell has talked about maintaining low interest rates for at least another 2 years. Finally, this is not the first time yields have risen. History suggests markets have continued to grind higher with higher yield, and inflation has been in check around 2% for a decade now. I think the sudden and drastic rise in yields is driving the sell-off. Also, up until last week, stocks have been on a tear. Investors are looking for a reason to sell. Which brings me to my conclusion. Everything that is happening is normal. What we are seeing is noise. Buy the dip. So how am I managing this dip? For most investors, investing consistently and automatically is the way to roll, and timing the market just now works. To be honest, so far it is just a bump on the road. We have yet to see any major drawdown. Tech-heavy Nasdaq got hit hard and is down 7%, but both S&P and Dow are off only 3.5%. Nasdaq is the index I track and typically buy dips when it falls 10%, 20%, and 30%. So if market continues to sell off, I will drop new money when Nasdaq enters correction or drops 10%. If not, I will stay put. And if it continues to fall further, well, I just bought the market at least 10% cheaper. There's a link in the description if you want to track my portfolio. Have a plan and stick with it. All-time highs or sell-off is not a reason to not invest consistently. That's all I have, guys. Thanks for tuning in. Ignore the noise and stick with your plan. Thoughts, comments? Until next time, peace.